All right, our first question for 2026 in regards to real estate in Southern California comes from Sierra, from Alicia Viejo. And Sierra says, I was doing the math on buying a home and it doesn't look like we'll even make money in 5 years. Am I doing this wrong? Now, Sierra, when you submitted this question, by the way, if you want us to answer your question, just go to steveolsongroup.com/ask and you can submit your question there. We'll answer the question and then email you a copy of the video once we put it out there. Sierra did not give any backing math or like any formulas or any links that she used to come across with this. So, Sierra, if you want to send that to me, I'm happy to make another video and justify what I'm going to tell you. But I did a little bit of research on Alicia Viejo, and we're going to do some math based on a purchase price of $1,700,000 in 2026, and how long if you pay $1,700,000. I'll give you some assumptions, interest rates, HOA, taxes, all of that stuff. How long it's actually going to take to break even on the home if you need to sell it. The numbers are going to shock you. I'm a math person. I know math probably better than most. And the numbers that I came up with is not what I was expecting. So let's get into that. And I'm going to give you some comparing and contrasting, actually. If you were to rent during the same time, paying market-based rent and taking the difference between the mortgage payment and your rent, and then just putting that into a Vanguard index fund, their S&P index fund, would you have ended up better 19 years from now doing that than owning a home? I think the results from that are going to shock you. So here are the assumptions that I wrote down. Number one, the average sales price in Alicia Viejo, we're going to use $1,700,000. So I'm going to assume that you're going to put down 20%. That's going to be $340,000, which means your loan amount is going to be $1.36 million. And I'm going to assume that your interest rate right now, we'll use a simple one, 6.25. Yes, you can get into the fives with certain things. You can do ARMs and all that stuff, but we're going to do a 6.25 rate with 30 years, okay? So that means when you take your mortgage principal and interest, now I didn't include insurance, so insurance is different everywhere, so we're gonna leave that out. That means you're paying about $100,600 per year. Okay. HOA, I'm going to assume you're going to pay probably around $3,500 a year. Property taxes are going to be around $17,000 because they're about 1%. And then we're going to forecast that annually you're going to have repairs somewhere in the $3,500 per year range. You got to factor all this stuff in because homeownership is expensive. That means annually you're paying $124,520 per year to own a $1.7 million home. That's a lot. Right? That means if you're paying $124,520, I think that's like $10,375 a month or something like that. That means you're probably making 30 grand, $360,000 combined salary if you're married, 30,000 to 36,000 a month if you are single. So let's talk about this. Your year one pay down, because of how 30-year structure is only $15,500, which means your true annual cost of owning this home, like the amount of money coming out of your pocket that you are pouring into this with equity buy down and all of that stuff, interest, all that, is $109,000 per year. I would write that number down. I probably should have written this on the screen. Maybe we'll do that on the next video. I'm going to assume that on average, we're going to appreciate 4.5% annually over the next 19 years. We're going to go through a dip. That's going to happen. We're going to go through multiple dips in 19 years, right? So you're going to have some that are going to go way up, and then we're going to go down a little bit, then we're going to go way up, and then we're probably going to go down. That cycle is probably going to happen twice in 2 years. But if you blend the average over the next 19 years, which is what we're going to talk about, 4.5%, I think, are fair. When you go to sell the home, closing costs are probably going to be 7.5%, give or take, 1 to 1.5% in closing costs, and then repairs. You got $4,000 in repairs, 5 to 6% in real estate commission. So we've got that number's factored in. Okay, so I ran this through 3 different calculators. I ran this through Excel. I did it myself. I ran it through ChatGPT. I ran it through Claude, and then I found one calculator online that I ran through. Believe it or not, the calculator that I found online spit out totally different numbers than when I ran it through Claude and ChatGPT and Excel, which all pretty much came up with the exact same number, plus or minus 1/10 of a point. So to get to this, what we need to do is we need to take the sales proceeds, take out the remaining loan balance, take out the selling costs, take out your down payment because you already paid that in, and then take out all of your true cost expenses. Here's the number it came up with. You ready for this? About 19 years to break even. 19 years. Now, the biggest factor we're facing right now, you're like, 19 years of owning a home and I break even? And the answer is yes. And here's why. If we're only factoring 4.5% appreciation year over year, and your interest rate is 6.25, your interest rate is losing money year over year, right? So we have to wait for the compounding effects of 4.5% of gains to outpace that interest. That's going to take a while for that to happen. But here's the number. In year 20, if we go up 4.5% a year, that means you're going to sell your home for 4.1 million. So it's going to go about up 2.3 times, which I think is a fair assumption. Net after selling costs is going to be about 3.8 million. Your remaining loan balance from that original 1.4 is going to be about 720,000. And that means at closing, your cash received as about 3.07 million. And so you're saying like, wait a second, Steve, in 20 years, I'm going to sell my home for 4.1 million and I'm going to get a check for $3 million. I made $3 million, right? No, you didn't make $3 million. And here's why this is not talked about. The reason why this is not talked about is because this is a major number. And if the banks knew that we were talking about this, or like the banks are never going to talk about this because they just want to say, congratulations, you owned a home for 20 years. You made $3 million. Like there was probably nothing else that you did to make $3 million. But the numbers don't stop there. In order for you to make $3 million in 20 years, you had to invest a down payment of 340, right? So that's money that's getting paid back out of that 3.07 million. And get this, you had to pay $109,000 a year times 20 years, which would be about $2.18 million in expenses you had to pay to own that home for 20 years, plus your $348,000, your $340,000 payment. So if you add the 2.18 million to 348,000, that's going to come up with about 2.52 million. Now, on year 18, that didn't happen, right? If you do, maybe I'll put a chart in the blog post. If you guys want to click the link in the description, I'll show you that. But when you get that cash of 3.07 million and you back out the 2.52 million, you've got about a $500,000 left over. The year before, that number is significantly smaller. And this is at about year 19. Now, I know what you're probably thinking, like, it's better than renting. And the answer is yes, it is better than renting because all of that money we spent for 19 years, we're basically getting all of that refunded on year 20 to us, right? So it's kind of like a forced savings account that we put in there. So if you bought a $1.7 million home, put 20% down, 6.25% interest rate, and 4.5% appreciation plus taxes, all that fun stuff. I did not include insurance, which is definitely going to be a hefty sum that's going to change these numbers a little bit. In about 20 years, you're going to get all of that money back, right? In the meantime, it's costing, you to do that. You got to pay the mortgage. There's some, tax savings that you can do. There's some, finagling you can do to make that number a little bit better. But there is one thing that is going to change, and that will be rates. Now, we'll talk about it later on today in another question that somebody asked. Rates are never going back down to 3%. It's just not going to happen. If you're on the fence right now thinking like, hey, rates are going to hit 4 something, and when they hit 4 something, I'll be back in the market. Two things that I would be wary of. Number one, that's never happened twice in the history of the United States economy, so I wouldn't bet on that. And number two, if rates somehow do drop to 4.5%, the price of a home is going to skyrocket right back up because people's purchasing power increases for that, right? So it's kind of like do I want rates to go up or do I want the average sales price to go up? You can't have it both ways. But what this doesn't talk about is that I'm assuming that you're going to keep the exact same mortgage for the next 30 years. I know that's not going to happen. Almost nobody keeps a mortgage for 30 years because rates fluctuate. So I am going to assume that over time, the rate may drop down to 5.25, 5.19. Maybe you may get a high 4 here and there for like a couple of weeks. That may happen. I don't want to be a Debbie Downer. I do believe that the economy will be resilient and rates will fluctuate. If you time that right, even just a 1.5 point difference significantly changes the numbers on this, significantly. So think of this as kind of like worst case scenario. Now, is this going to go from 20 years down to 5? No, it's not, right? And I have this argument with people all the time. I've owned this home for 3 years and I'm already up this much. I should just sell and cash out. Well, you could cash out and get reimbursed for everything that you paid so far, but chances are you lost money in the sale because of commission, closing costs, holding costs, repairs, all of that fun stuff. Now, to be clear, does this mean I'm suggesting you shouldn't own a home? Absolutely not. It's still an amazing investment, right? But money in versus money out in this specific situation, assuming taxes never go up, right? We know they're going to go up. I did not factor for increasing property taxes. Assuming that HOA doesn't go up, HOA is going to go up. Assuming home insurance doesn't go up, home insurance isn't in this at all. That's a big factor, especially for homes in Southern California. And I did not factor if you were going to refinance the mortgage if it goes down, right? So there's a lot of things that you can manipulate those numbers with. Now, let me take you for like just for fun. Let's say that and I know quite a lot of people that are like this. Let's say that like, hey, I only want to own other people's real estate that they pay my mortgage. Like I only want to own investor real estate. I know quite a lot of people, more than you would think, that rent their primary residence and then buy investment properties. And then they do it enough to where their primary is paid for. And then when they have enough cash flow for that to buy their own home, they use the cash flow for that to pay for the existing home. And figuratively, they're gaining equity with all their investment properties, and the cash flow from the investment properties is paying their mortgage. So net, it's a zero and it's an appreciating asset. It's an amazing way to own real estate. It does take a while to do that. It's not something that you can do, overnight. It's a big plan. But let's take that out of it. Let's take investment property. Let's not talk about any of that. And let's just say, Steve, well, in a market where rates are so high, rent is significantly cheaper than owning a home right now. Like in some cases where we live in Carlsbad, the number is almost half, right? So let's say in Alicia Viejo, if we go back to the $1.7 million home with 20% down, that mortgage payment is about $10,000. I think it was $375 a month, about without insurance and all of that. So maybe it's upwards of 11. I don't know, depending on what insurance costs up there. I think you could probably rent that same home for $6,000 a month in Alicia Viejo. I haven't done deep research, but that's probably what it's going to be, which is about almost half of what the mortgage is, right? We'll leave that aside. So let's say, Steve, what if I just rented a home and then the difference between my rental payment and the mortgage payment, I took all of that money, which in this case would be $4,375. And let's say I just put it in a Vanguard fund for 19 years. And historically, what I found is that the Vanguard S&P index fund, there's a whole bunch of Vanguard funds, gives about a 10% return a year over the last 19 years, which is amazing. It outpaced everything else. Was a really good investment. So here's the numbers I came with. This is kind of crazy. If you paid rent for $6,000 a month, and then took the difference, $4,375, and put that all in a Vanguard index fund. At the end of that, you would have invested $997,500 into that Vanguard fund. This is 19 years of monthly investments of $4,378. That's 228 months, just so we're clear. $997,000 and $500. That's how much you would have invested. That $1 million investment would have been worth 2.95 million today. So you would have made about $2 million on that money. So at the end of the day, you would have paid somebody $6,000 in rent. We should do the math on that. $6,000 a month times 228 months, which means you would have paid $1,368,000 in rent. That sounds crazy to say. $1,368,000 in rent. Let's write this down. And then you would have paid $997,000, and that's so we're going to say plus $997,500. That means all out of pocket, you would have spent $2.365,500. But you would have had the financial instrument that gained about $2 million bucks. So you would have spent $2.365 million, and then you would walk away. Yeah, a little over $2 million. You would have walked away. So you would have had a financial instrument of $2 million in your pocket. Okay, so let's talk about like money in your pocket. So you spend $136,800 in rent. You spend $997,000 in investments. So that money is gone. You spent $2,365, so that money is gone. At year 19, you now have $2 million cash in your pocket. Okay. So we spent all of that money. We got all of that back. So really, in order to do that, we lost $1 million if you think about it that way, right? We lost about $400,000 doing that. Okay. We spent 2.365 and then somebody wrote us a check back for $2 million. That's what our index fund gained over all that period of time. Now, I don't know about you, but if I take $365,500, which is what we would have paid, and we divide that by 228, I technically paid $1,600 a month in rent for 19 years. Not a crazy number. In 19 years of owning a home, you got all of that money plus 500,000 back. So you didn't lose any money. So in 19 years, the argument of paying rent plus investing the difference between now and then, yes, you would have paid 236 and then had $2 million in your pocket. When you were done, if you would have owned your home, you would have done the exact same thing, but you would have had all of that money in your pocket reimbursed with you. So I know this money is weird. Maybe in the blog post, we'll put like a little Excel grid, like side by side, so you can see like cost, money left over, cost, money left over. My gut talking about this out loud would probably tell you that homeownership was still better. Now, there are a couple like things that, like, remember how there were asterisks around buying the home? There's asterisks around renting as well. I did not forecast rent going up in 20 years. It's 100% going to go up. I did not forecast that you're going to be in the same home every single year. So they're going to be moving costs. So that number is going to change. The instability of renting a home, meaning can somebody physically rent their home for you for 19 years straight? In most cases, no. They can't rent the home from you that long. So there's going to be a lot of change in that. There's going to be a lot of disruption. Some of it's going to be planned. Some of it's not. Some people love moving every couple of years. Some people, like if you're somebody who wants to be in the same place for 10 years, 100%, I would buy the home. I would not rent it, right? So there are, nothing ever works exactly how it's supposed to, right? It's important to understand that, especially in real estate. But I think when you look at the raw numbers, we'll put it in the blog post, I can almost assure you that even though your break-even point is 19 years, financially, it's going to make more sense to buy the home.